Most people lose money in the stock market not because they pick the wrong stocks, but because they skip 5 critical steps before they ever hit the buy button. These steps are simple, they're proven, and the greatest investors in history all swear by them, yet almost nobody does them.
Today, I'm walking you through exactly what those 5 steps are. Get them right, and you will already be ahead of the vast majority of investors. I'll show you the exact framework, the same framework Warren Buffett, Peter Lynch, and every serious investor uses before they touch a single share. I'll show you the mistakes that wipe out beginner portfolios. And at the end of part 2, I'll show you the one tool that does all 5 of these steps for you if you don't have the time to do it yourself. Stick with me all the way through, because the difference between someone who builds real wealth in the stock market and someone who spends 20 years spinning their wheels comes down to these 5 things. If you've been thinking about buying stocks but haven't started, this is for you. If you've already lost money in the market and you want to know why, this is for you. If you have cash sitting on the sidelines and you're afraid to invest it, this is definitely for you. If you've been dumping money into individual stocks based on tips from friends, social media, or random news articles, this is especially for you, because I'm about to show you exactly why that's not working and what to do instead. Here's what we're going to go over across both parts. 5 steps, 5 things every serious investor checks before buying any stock. Step 1. Understanding the business. Most people skip this entirely, and it costs them everything. Step 2. Evaluating the price. A great company can still be a terrible investment if you pay too much for it. Step 3. Knowing your financial foundation. Without this, one bad market day can wipe out years of progress. Step 4. Understanding your time horizon. This one mistake alone is responsible for more wealth destruction than any bad stock pick. Step 5. Protecting yourself from your own emotions. This is the one nobody talks about. And it's the one that separates the people who build real wealth from everyone else. Today in part 1, we're covering steps 1, 2, and 3. Let's get into it. Step 1. Understand the business. Before you buy any stock, you need to understand what the company actually does. Warren Buffett calls this your circle of competence. At the start of the 20th century, around 2,000 automobile companies existed. You might have correctly predicted that cars would transform the world. But out of those 2,000 companies, only about 3 survived long-term. Knowing a technology will change the world and knowing which company will win are 2 completely different skills. Right now, everyone is excited about AI. But can you explain how a specific AI company makes money? Do you understand its competitive advantages and why customers wouldn't switch to a competitor? If you can't answer those questions, you're not investing. You're gambling. Here's the test. Write down in plain language what the company does and how it generates revenue. If you can't explain it like you're telling a friend over coffee, you don't understand it well enough to own it. Peter Lynch generated 29% annual returns for 13 straight years using this same philosophy. He invested in businesses he encountered in everyday life, spotting trends at malls and restaurants long before Wall Street caught on. Don't buy a stock because someone on social media called it a moonshot. Buy it because you genuinely understand the business behind the ticker. Now here's what most people don't realize. Buying an individual stock is not the same thing as investing in the market. When you buy the S&P 500 index fund, you own a piece of 500 companies. When you buy an individual stock, you're taking on what's called non-systematic risk. That's the risk of one specific business failing. And that risk is not compensated, meaning you don't get paid extra for taking it. The statistics on this are brutal. A landmark study from Arizona State University looked at every single stock in the U.S. market since 1926. Only about 4% of stocks generated all of the market's returns over that entire period. The other 96% of stocks, taken together, matched the returns of one-month Treasury bills. That means you would have been better off keeping your money in the safest, most boring investment on earth than buying 96 out of every 100 stocks that existed. Another study looked at the Russell 3000 index from 1980 to 2014. 40% of those companies suffered a decline of 70% or more from their peak value without a significant recovery. Not a temporary dip, a permanent, catastrophic loss. Those are the odds you're playing against when you buy individual stocks without a framework. That's why understanding the business is not optional. It's the foundation. If you can't explain how a company makes money, why customers stay with them, what happens if a competitor comes in? You have no business owning that stock. Full stop. One more thing on this. If you own stock in the company you work for, be extra careful. There's a well-documented bias called familiarity bias. When you know the leadership, when they treat you like family, when you believe in the mission, it becomes almost impossible to objectively assess the risk. Employees of Enron thought they were safe. Employees of Lehman Brothers thought they were safe. Employees of Bear Stearns thought they were safe. All three of those stocks went to zero. Step 2. Evaluate the price. A great company is not automatically a great investment. The price you pay matters enormously. The most common measure is the price-to-earnings ratio. If a stock trades at $50 and earns $5 per share, the ratio is 10. You're paying $10 for every dollar the company earns. But here's where most people get tripped up. Take Apple. If it trades at $200 and earns $6 per share, you're paying 33 times earnings. Sounds expensive. But if Apple is growing earnings at 25% annually, that ratio actually looks fair, compared to a slower company trading at 10 times earnings with only 5% growth. The cheap stock is actually more expensive relative to its growth. Buffett talks about building in a margin of safety. Think of it like driving a heavy truck across a bridge. If the bridge is rated for 10,000 pounds and your truck weighs 9,800, you'd feel fine crossing a shallow stream. But across a deep canyon, you want a lot more room for error. The riskier the investment, the bigger the gap you want between the price you pay and what you believe the company is actually worth. Now here's the part that trips up almost every new investor. They see a stock go up 30%, 40%, 100% in a year, and they assume that means the strategy worked, that the pick was smart, that they can do it again. But you have to separate skill from luck, and you have to understand something called volatility drag. When a stock is highly volatile, swinging up and down violently, the compounding math starts working against you. If a stock drops 50%, it needs to gain 100% just to get back to break even. If it drops 80%, it needs to gain 400% to break even. That's not a math trick. That's the reality of how percentage losses work. So even if you pick a stock that has a spectacular average return, if it comes with massive volatility, the actual money in your account grows much slower than the headline number suggests. Sometimes not at all, sometimes negative. This is why professional investors don't just look at return. They look at risk-adjusted return, because you don't get to choose which path your investment walks. Simulations run on aggressive stock-picking strategies show that in the bottom 10% of possible outcomes, you can lose 80% of your money over 10 years. Compare that to a diversified market portfolio, where the bottom 10% of outcomes still averages a positive return. You don't get something for nothing. Higher potential upside comes with higher potential downside. And when the downside hits, it's not theoretical. It's your rent money, your kid's college fund, your retirement. So when you evaluate the price, you're asking 3 questions. Is the price fair relative to the company's earnings and growth? Is there a margin of safety built in if things go wrong? And can I afford to hold this stock through the drawdowns that are guaranteed to come? If the answer to any of those 3 is no, walk away. Step 3. Know your financial foundation. If you're carrying high-interest credit card debt at 20 or 30%, investing while holding that debt is like filling a bucket with a hole in the bottom. The market returns 8 to 10% per year on average. If your debt costs more than that, pay it off first. Same with an emergency fund. Have 3 to 6 months of expenses saved in cash before you put anything into stocks. Without it, a market downturn could force you to sell at exactly the wrong time. Here's why this matters more than any stock pick you'll ever make. The people who build real wealth in the market are not the people with the most skill. They're the people who never have to sell during a crash. When the market drops 30 or 40%, and it will several times over your lifetime, you have 2 choices. Ride it out and let it recover, or sell and lock in the loss. The people who ride it out win. The people who sell lose. But you can only ride it out if your rent is covered, if you have grocery money, if your car isn't broken down, if you don't need that portfolio to survive. Every time the market crashes, wealth transfers from the people who need their money to the people who don't. Your job is to be on the receiving side of that transfer. Here's the specific breakdown. First, kill any debt above 8%. If your debt costs more than the market pays, you're losing money by investing. Second, build a cash cushion equal to 3 to 6 months of essential expenses. Keep it in a high-yield savings account. Cash you can access in 24 hours. Third, make sure you have the right insurance coverage, because a single uninsured emergency can wipe out years of investment gains overnight. Only after all 3 of those are handled should you invest a single dollar in stocks. Let me give you a real example. 2 investors, both start at age 30. Both invest $500 a month into the S&P 500. Investor A has an emergency fund, 6 months of expenses in cash, no credit card debt. Investor B skips all that, dives straight into investing. No emergency fund, some credit card debt. Fast forward 5 years. Both have $30,000 in the market. Investor B loses their job during a market downturn. The market is down 30%. Their portfolio is worth $21,000. No emergency fund. Bills stacking up, they sell at a 30% loss. Investor A, same job loss, same market downturn. But they have 6 months of expenses in cash. They keep their investments intact. When the market recovers 18 months later, they're back to where they were. And now they have the confidence to keep going. Same salary, same investment amounts, completely different outcomes, based on one thing only: whether they built the foundation before they built the portfolio. The people who build generational wealth aren't smarter than everyone else. They just don't skip steps. Step 4. Understand your time horizon. Money you need within 5 years generally shouldn't be in stocks. The stock market has crashed 19 times in the past 150 years. Every single time it recovered and reached new highs. But that only helps you if your timeline is long enough to ride it out. Here's the specific breakdown by time horizon. Money you need in the next 1 to 3 years. Savings account or short-term treasury bills, not stocks. Because if you need that money in 18 months and the market crashes, you're forced to sell at a loss. Money you need in 3 to 5 years. You can start adding some conservative exposure, but the majority should still be safe. Money you don't need for 5 to 10 years. Now you can start increasing stock exposure. You can weather most downturns because you have time to wait for recovery. Money you don't need for 10 years or more. This is where stocks belong. This is retirement money. This is generational wealth money. Here's what most people get wrong. They put money they need next year into individual stocks because they saw someone else make a quick gain. Then when the market drops, they panic and sell. That single mistake, mixing short-term money with long-term investments, has ruined more portfolios than any bad stock pick ever will. Buffett said it best. The stock market is a device for transferring money from the impatient to the patient. The math on this is undeniable. If you had invested $10,000 in the S&P 500 in the year 2000, right before the dot-com crash, and left it alone until today, you'd have well over $50,000. If you had panicked and sold at the bottom, you'd have a fraction of that. Same money, same market, completely different outcomes, based on one thing only: time horizon and the discipline to match it. Let me give you one more powerful concept. It's called sequence of returns risk. 2 people retire at 65 with the same portfolio size, same asset mix, same withdrawal rate. But one retires in a year when the market drops 30% right after they retire. The other retires in a year when the market goes up 20%. Even if their long-term average return is identical, the first person can run out of money and the second person can leave millions to their heirs. Why? Because when the market drops early in retirement and you're forced to sell shares to live on, you're selling more shares to get the same income, which means fewer shares left when the market recovers, which means less compounding for the rest of your life. The closer you get to needing the money, the less risk you should take. Time horizon isn't just about how long you can wait. It's about how much you can afford to lose right before you need the money. Step 5. Protect yourself from your own emotions. Fidelity once looked at which accounts performed best. The top performers belonged to people who had essentially forgotten they even had an investment account. Doing less often beats constantly trading. When the market drops 10 or 20%, what are you going to do? Are you going to panic and sell everything? If that's your instinct, you need to be honest about it now, before you have money on the line. Set up automatic monthly contributions and remove the emotion from the equation entirely. You invest the same amount whether the market is up or down. That consistency is what compounds into real wealth over time. Your emotions are not just a nuisance. They are the single biggest destroyer of wealth in the stock market. And they show up in specific, predictable ways. The first one is overconfidence. When you win a few trades in a row, your brain tells you it was skill. It almost never is. Attributing luck to skill leads people to bet bigger and bigger until they inevitably lose it all. The second one is the endowment effect. Once you own a stock, you value it more than it deserves. If you bought a stock at $5 and it went to $50, would you keep it? Most people say yes. But here's the honest question. If you had the cash in your hand right now, would you buy that stock at 50? Most people, when asked that way, say no. That's the endowment effect. The third one is FOMO, fear of missing out. Someone tells you about a stock that just went up 200%. You feel like you're falling behind. You buy in at the top, then it drops. This is the single most common way people lose money in the market. The fourth one is overtrading. You have a plan, then you see a headline. You get bored, and you make a trade that has nothing to do with your plan. There's a real story about a trader who kept making thousands of dollars in the first hour of every day, and then giving it all back by lunchtime, because he couldn't stop trading. His solution was not more analysis. It was a wind-up alarm clock in the kitchen. When it rang at 10:30, he was forced to physically leave his desk to turn it off. That physical break was enough to break the pattern. That's what discipline looks like. It's not white-knuckling your emotions. It's designing your environment so your emotions can't hurt you. Here's what to do. The 24-hour rule. If you feel the urge to buy or sell a stock outside of your normal plan, wait 24 hours before you do it. This one rule alone will save you from 90% of emotional trades. The position size rule: never put more than 5% of your portfolio in any single stock. This protects you from any single stock destroying your net worth. The news blackout: turn off financial news notifications on your phone. The harder you make it to check your portfolio, the less you'll trade. And the less you trade, the more you'll make. And the automation system: set up automatic contributions to your investment account on the same day every month. Same amount, whether the market is up or down. The decision is already made. You don't have to think about it. You don't have to feel about it. That's what separates the wealthy from everyone else. Not intelligence, not luck. Systems, rules, discipline built into the structure of their lives so they never have to rely on willpower in the moment. Let me tie all 5 of these together. Understand the business. Make sure it falls within your circle of competence so you actually know what you own. Evaluate the price. Use valuation metrics to determine whether you're paying a fair price. Build in a margin of safety. Know your financial foundation. Get your financial house in order before you invest a single dollar. Understand your time horizon. Match your money to the right timeline and have the discipline to stay invested. Protect yourself from your own emotions. Build systems that protect you from yourself during the worst moments. When you combine these 5 steps, you stop reacting to headlines and start making decisions based on logic and evidence. You stop chasing whatever stock is trending on social media. Most importantly, you gain the confidence to stay invested through the inevitable rough patches, which is ultimately what determines your long-term success. The framework you just learned is the same framework Warren Buffett used to build a $100 billion fortune. It's the same framework Peter Lynch used to generate 29% annual returns. They're not doing anything you can't do. They're just doing it consistently, and they're doing it for decades. Start doing it today. Now let me answer the most common questions I get about all of this. Can I start with just $100? Yes. You can start with as little as $10 with fractional shares at most modern brokerages. The amount you start with matters far less than the habit of starting. Someone who invests $100 a month for 30 years will have more money than someone who invests $10,000 once and never adds to it. Consistency beats size every single time. Does this work if the market crashes right after I invest? Yes, if your time horizon is long enough. Every single market crash in U.S. history has been followed by a full recovery and new all-time highs. The 1929 crash, the 1987 crash, the 2000 dot-com crash, the 2008 financial crisis, the 2020 COVID crash. Every one of them recovered. The key is not avoiding the crash. It's staying invested through the crash. How do I know which stocks to actually pick? This is where most people freeze, because doing the research on individual stocks takes hours per company. Most people don't have that time. That's why the vast majority of investors are better off buying an index fund like the S&P 500. You get instant diversification, low fees, and historically strong returns. What about penny stocks or crypto? Everyone is telling you they're making money on those. There's a difference. The people who lost money don't post about it on social media. You only see the winners. That's called survivorship bias. The vast majority of speculative investments end in loss. Should I try to time the market? Multiple decades of research shows that even professional fund managers can't consistently time the market. The strategy that works is dollar cost averaging. You invest a fixed amount every month, regardless of what the market is doing. Over time, you get a good average price, and you never have to guess. What if I'm 40 or 50 and just getting started? It's not too late. If you start today at 40 and invest consistently for 25 years, you can absolutely build significant wealth. The worst thing you can do is decide it's too late and give up. Do I need a financial advisor? Not necessarily. For most people, a simple 3-fund portfolio will outperform 80% of actively managed portfolios over a lifetime. If you have a complex situation, an advisor can add value. But for the average person just trying to build wealth, the fees will eat into your returns more than the advice adds. What if I don't have the time to do all this research? That's the honest question most people are afraid to ask. Doing all 5 of these steps for every single stock takes hours per week. For someone with a full-time job, a family, and a life, it's just not realistic. That's exactly what I want to talk about next. What's the biggest mistake beginners make? Treating investing like gambling. Buying a stock because someone on social media said it would explode. Selling in a panic when the market drops. Investing is not about being right on one stock. It's about being consistent over decades. Boring wins. How much should I invest each month? Start by saving at least enough to get any employer 401k match. That's free money. Then aim to invest 15 to 20% of your gross income. If you can't hit that right away, start with whatever you can, even $50 a month. The important thing is to start. What about taxes? Every time you sell a stock at a profit, you owe taxes on the gain. If you held it for less than a year, it's taxed at your regular income rate. If you held it for over a year, it's taxed at the long-term capital gains rate, typically 15% for most people. Use tax-advantaged accounts. 401k, Roth IRA, HSA. Max them out before you invest in a regular taxable brokerage account. What if I'm scared to start? Almost everyone is scared to start. Not investing is also a decision, and it's usually the worst one. Inflation eats away at cash sitting in a savings account. Every year you wait to start is a year of compound growth you can never get back. The best time to start was 20 years ago. The second best time is today. Now, let me ask you something honest. Would you rather do all 5 of these steps yourself? Reading annual reports, studying financials, tracking competitors, analyzing valuations every single week? Or would you rather have a tool that has already done all of that work for you and simply tells you which stocks to buy and why? If you said option 2, here's what I recommend. There are professional stock research services that do exactly what I just walked you through. They analyze the business. They evaluate the price. They give you specific stock picks every single month based on a proven framework, with full explanations of why they're recommending each one. So you're not just blindly following someone. You're learning as you go. Their track records are public. Their reasoning is transparent. And they cost less per day than a cup of coffee. The one I personally use and recommend is linked in the description below. Check it out and see if it's right for you. Not financial advice, for educational purposes only. If this was useful, subscribe. I break down investing concepts every single week. Share this with someone who's been thinking about buying their first stock. These 5 steps could save them thousands of dollars in avoidable mistakes. Thanks for watching. See you in the next one.